All right, guys, let's dig into some real estate fundamentals. So I love real estate. It, to me, is such a stable wealth building vessel for people that is, for me, like long-term goals. So essentially, every time that we invest into real estate, it's a long-term play. And it's one of the vessels that, if we understand why wealthy people choose real estate, or if you've ever heard like, okay, real estate is wealth building, it's not quick money making, is because of multiple reasons. It has tax benefits for us. It is something that simultaneously, so at the same time, appreciates, and you can depreciate it and you can leverage it really quickly. And we are going to pull apart what some ideas might be best for you with whether you should do commercial real estate or residential. And you can leverage both of them, and there's pros and cons to each one. So I want you guys to understand, just to start to get your brains thinking in the world of real estate, how $100,000 invested into real estate can outperform $100,000 in stocks. So it's not linear. When we put $100,000 in stocks, the market usually, it fluctuates year to year, but 5 to 10%, I think the median's right around like 7-8% of the market is what you can over a lifetime just bank on that money making you in the stock market. When we look at real estate, for simple numbers, if we take $100,000 and if we are going to turn it into passive income through solely investment, and to get into real estate, you do not have to do your first acquisitions, your first projects as an investor. You literally can leverage your getting your foot in the door, your first time buying, or some other ways, or being the resident of it, to get in at a way lower barrier. But just hypothetically, let's start thinking, if you took $100,000 and did an investment property. So think about having to put 20% down for investment properties. Sometimes on commercial, that's up to 25%. It really depends on your lender, your credit, your assets, your cash flow, all of that stuff. But if you take $100,000 and it's 20% down, that means that you are able to buy a $500,000 property. So $500,000 here in Battle Creek, Michigan, let's say hypothetically that can get you a 5 to 6 unit property. Maybe even bigger, honestly, $500,000, you might even be able to find a multi-unit that is closer to, 6 to 8 units or something. So you're taking that $500,000, you're going to buy a multi-unit with it. And we have multiple things going on. So the first thing I would do is say, okay, my note on a $500,000 property, so it's only $400,000 that I'm getting lending on or paying a mortgage on, and say that runs around like $4,000. So you have that note at $4,000 a month. That's what you put $100,000 in. It's costing you $4,000. You're going to have, of course, all the other expenses of insurance and property management if you choose that direction, and bills and all of that. So say it maybe is up to $6,000, give or take, costing you. Okay, cool. So if I want to make more than stocks I can make 8%. On real estate, I like to shoot for 20 to 30% on my money, which means if I put $100,000 in, I'm making $20,000 to $30,000 a year on that money, aka that property. So you break that down. If it's 30% that I'm making, I want to make $2,500 a month on that property. If it's a 20% margin or 20% that I'm making on it, I want to cash flow $20,000 a year. Broken down monthly, that's $1,667. So now I know my cost each month that property's costing, what I want to make. So we can think about this as gross. So we put them together to get a gross amount monthly. So it needs to bring in, for me to do that project, it needs to bring in, for easy numbers, we said $6,000 cost, $8,500 a month. That's my 30%, making 30%. It needs to bring in $7,600, $7,700. That's me making 20%. Breaking even, stuff's hitting the fan, but it's at least paying the bills, is that property would be making that $5,000 to $6,000 a month, right? So you go, okay, it has 8 different units and they each rent for $1,100 each, or let's make it easy, $8,000, $1,000 per unit. That property is making $8,000 a month. take off the bottom line, which is your expenses, take off that $6,000, it's cash flowing $2,000 a month. It's like literally lands you $25,000. It's in that 25%. So you're making $2,000 to $2,500 a month on it. That means at the end of the year, you're going to have $25,000. So in stocks, $100,000 at 8%, at the end of the year, you had $8,000 to play with. At the end of the year on a property, you have $25,000. Now, it's not linear because, okay, that property might need a new window. This might happen. You never know what's going to happen. But it's also not linear because not only did you make 3 times the amount of money on it, right? Rate of return was 3 times higher on that, on real estate, but some other things happened. You have appreciation of the property value. So the appreciation, I usually like to say 3%. And again, I am not a real estate professional. I'm just going to share how my brain works and how I'm building my own portfolio. Take what you can, take what you want, let it be a mustard seed, do research, let me know if you find something better. But I like to use conservative numbers, and I like to think about it appreciating by like 3% each year, that property value. So even at 3% value, $500,000, so say it's now worth not $500,000, but at the end of the year one, it's worth $515,000. Okay, so I've got $15,000 built up in equity in that property, right? I bought it for $500, now it's worth $515. Cool. The other thing that happens is even though I have a mortgage at like 6 to 7% because they're a little bit high right now, every single month, those tenants are paying the bill or paying the note on that debt that I took out. The bank's my partner, right? The bank and I are working together. Like, hey, I'll borrow this. I'll do all the sweat equity of running this property, finding tenants, making this successful. I'm going to pay you a percentage rate. These people are going to pay the note, pay it for the property, which pays my note. Guess what? That also has principal and interest on the note, right? So the amount each month going to interest is paying down what you bought that property for. So it is almost like a hockey stick or like a graph up on that. In the beginning, you're paying a ton in interest because they took the highest risk. They gave you all the money. Towards the end, a ton of your payment is going towards your principal. So you're actually like making some headway on that. And I'll give you a life hack on that. Every January, make a full extra payment on your properties. You will get there so much faster and save yourself so much money and interest doing that one life hack. Back to what we're doing. So every single month they are paying that, even if it's only $400 or $500 a month that's going towards principal, still $400 to $500 a month going off the principal, what you owe on that. So the property's increasing in value. Your tenants are decreasing or paying down the note, decreasing what you owe. Meanwhile, you're cash flowing on your original investment 20 to 30%. So you have a holdings company that's starting to get a little pot of money in it as well. So hypothetically, 5 years down the road, you can think with that example right there, we've got $125,000 in a holding company. We have that property is probably worth another $50,000 to $60,000 in valuation, and you've paid off at least like $25,000, $30,000, $40,000 on your note. So now you owe $350,000 on the property. It's worth $550,000. You have $150,000 in a bank account or $125,000 in a bank account in a holdings company. Now we can start playing with the next project or the next cash flowing asset. Meanwhile, I'm a chiropractor, so I'm in my office just seeing patients, having fun. Yeah, I'm still making $2,000 a month on this property, and I'm set up to purchase another property and just keep adding more cash flowing business-like activities to my lifestyles. I no longer have to work day in, day out seeing patients to make money. I've actually cultivated a portfolio of things that are asset producing. The other thing is that this helped you against inflation, right? It's like a hedge against inflation because every year it's increasing year to year. It can equal out with it appreciating in value. And you're also building generational wealth. So that means that you can put it in an LLC for protection, but you're also generational wealth, right? Like my girls, I will have properties. It will come to them through trust. So instead of having to buy a house, pay taxes, if someone dies and they don't have it set up properly, they're paying taxes on that and paying like full amount. You can actually utilize a trust to take these assets and get them to your kids and your kids' kids so that they are set up for wealth building as well. So I hope that that kind of unlocked how real estate can start to be a key to your financial freedom. And I am going to go into even more on that empire of how we break that down on a commercial, because we can leverage value really quickly on commercial. And then how, if you're like, I just graduated, I'm a student, I just started a business, what's a way that I can get my foot in the door on the residential side or an Airbnb or a short term? We're going to go into that as well.